So, Jim, you're a fixed income guy.
Yeah.
How does a fixed income guy react to what's going on with trade right now?
I mean, it's hugely important. It's one of the biggest factors that's been moving the dollar really since February of this year. A lot of the uncertainties and tensions. The key takeaway here, because this is, at this point right now, I wouldn't say it's more of an understanding than it is an agreement at this point, and it's still not a done deal. But what it does do is it does show that the U.S. is softening some of its positions, and it's really willing to make a deal and negotiate at this point, which then has a ripple effect into, well, then what does that mean for Canada? What does that mean for the, for Europe, and then possibly even, the big kahuna? What does it mean for China? So, we may be at a stage here where maybe most of the bluster is over, maybe. We can't count on it, but now it's time to actually, put pen to paper and get a deal, and that should calm the markets, and that should bring, risk premia, back to more normalized levels, and that could create an asset rally.
So if, in fact, the risk goes back on, if this has been sort of a headwind, what does that do for the 10-year yield as a practical matter? Does that mean people sell off because they don't need those safe haven treasuries anymore? Yeah,
it should put some upward pressure on 10-year yields, although I'm not very, very hopeful that we get much above 3%. I think if we're still in a position where the Fed may be slowing down its pace of rate hikes going into 2019, it's going to be very, very difficult for the 10-year Treasury yield to materially get above 3%. That doesn't mean that we can't spike a little bit above, for a period of time. It just means that when we look at some of the neutral rates in terms of what the Fed is talking about, if they're going to end their cycle between 2.5 and 3, and that's sometime in, say, 2019, then the 10-year note's probably not going to be too far away from 3%. So kind of close to where we are right now.